really excited to have Scott join us today in a conversation around transitioning from growth at all costs to efficient growth. Scott, I think, is going to be a great speaker and a great partner for us in walking us through this topic. Just a minute on Scott's background. He is one of the most experienced builders and operators of marketplaces on the planet. And he has spent well over the past decade running and scaling a number of high-profile marketplaces. He's currently the CEO of StockX, where I have the great privilege of working closely with him. Prior to joining StockX, he ran the Americas business at eBay. And before that, he was the president of StubHub. Scott also spent 8 years at the New York Stock Exchange, where he was head of global listings. So given his incredible breadth of work across all these different marketplaces, we would be hard pressed to find somebody that knows the world of marketplaces nearly as well as Scott does. I'll also say at a personal level, he is among one of the most people I know, and he is a ridiculously good skier. So if you ever need somebody to partner with you in a ski race, Scott is your guy. So with that, Scott, why don't we hand it over to you? If you could just start by giving us quick background on who is StockX for those people in the audience that don't know, and how did you get involved with the company?
Sure, thanks. The proudest statement you made there, Roger, is my skiing prowess.
All true. It's all true. I've seen it firsthand.
So, so first of all, it's great to be here. It's great to join you today. It's been really great to hear some of these fascinating speakers, and proud to be among those presenting today. So just a little bit about StockX. StockX is a marketplace for high demand consumer goods, and consumers get access to products on our marketplace through live mechanisms of bidding and asking, very similar to stock market-like mechanics. And my connection to the company goes back to 2016, and I think it's uniquely situated and reflects my own personal history. The company started with this notion of being a stock market of things, and patterned literally after the New York Stock Exchange, StubHub, and eBay. And all of those elements have come together in a really unique consumer marketplace in StockX. And so for me, at this point in time in my career, it's a unique marketplaces that leverages some of the experiences of all of these other great marketplaces that I've had the opportunity to work at. And then today, what's been so exciting is to be on the frontier of introducing a really new way to transact in a redefined way of approaching commerce in high demand areas, which we're best known for in sneakers and streetwear, and new categories like watches and handbags and collectibles. And so it's been exciting to see all of these different marketplaces converge in this new marketplace called StockX.
That's great. No, thank you for the background. So, one of the themes of the conference today is shifting mindset that a lot of both investors and entrepreneurs have gone through, from grow at all costs to efficient growth. Sam Shank just actually did a really nice TED talk on this exact topic, and the journey that Hotel Tonight went through, where they had to make it that type of transition. And StockX, as you obviously know, has gone through a similar transition as well. Can you kind of walk us through that journey over the last year, and specifically, when did you know that you needed to transition from growth mode to efficiency mode? And were there any specific data points that you saw, or that other founders and CEOs should be on the lookout for when they have to think about making that migration again from growth mode to efficiency mode?
Sure. So part of this is actually macro, in the sense that themes come and go. And one of the themes that has been true since the financial crisis, and many of the great companies that emerged out of the financial crisis, was this opportunity when the economy was scaling, that growth was that thing that you wanted to take advantage of. And we have been almost in a 10-year time period where growth was the thing that was the tailwind for new ideas and new opportunities. And the second that growth isn't the only thing, and you have to be able to find other ways as a company to either navigate through a crisis or navigate through a different elevation of growth, there is a sentiment shift that's required. Here, we've seen it across the entire market, which is grow at our costs or having a path to profitability being important. But I think even for companies at various different stages, that trade-off between knowing when to grow and when to be efficient is critically important. But what I've seen at StockX is in still the very early stages. We're past the point of market acceptance where you've got product and market fit. We're almost past the point of having exit velocity, meaning you have a company of scale, and getting to that point where we as a company, now that we have a global platform, that we really needed to be able to find new opportunities to simply run faster, be more efficient with the ways that we were operating. And so the pivot we really started to make, and this happened at the end of last year, was more this realization that we were experiencing tremendous growth as a company, and we were part of a real changing dynamic in the industry, but scale brought new challenges. Scale brought new things that we needed to address on the foundation, and that we came around with the mindset that efficiency and doing what we were doing better at scale was going to unlock new opportunities for growth. And it required us to actually rethink our financial foundations and rethink the motivations with how we both attracted, maintained, and retained customers, but to be able to do it in a more scaled way and a more efficient way, not just, hey, let's just grow and get that next customer, get that next dollar of revenue. It became how we went about doing that became way more important.
Got it. Were there challenges in getting the team to buy into it? Because, culturally, it is a different mindset. I think about what an organization looks like, how they measure themselves and how they operate, just their cadence when they're thinking, growth is their North Star versus when efficiency is a North Star. So culturally, how did you get the team to buy into it? And how did you get them to agree that this was the right, transition for the company to make?
Well, I'd say we're still in the middle of that transition as a culture and as a company. We had the fortune of starting during a bull market, and up until this last year, that's really all we've known. And I think the mindset of our team has been growth and innovation almost exclusively, because there's been so much greenfield opportunity. Talking about efficiency is a different language. It's a different language for the team. It's a different language for the generation as well. When you talk about most of our employees and customers are millennial to Gen Z and younger, that notion of being efficient isn't as attractive as, hey, growth sounds so much more exciting. And so the notion of efficiency to us is really culturally communicating to the team about really how we do what we do faster, more efficiently, with greater integrity. And that does require a completely different mindset for our team. And so both communicating in a way that still has people excited about growth and innovation, we don't want to lose that, but this notion that we can go about it more efficiently is cultural change. And it's not just a financial decision that a CEO makes, but it's a cultural decision as to how do you infuse this notion of efficiency and growth. And that's a transition that a company like us that is going through as we go from this point of where growth was the only thing that mattered to saying, hey, there's something more.
Mm-hmm. Were there certain things that you did to kind of connect the new, vision with their actual performance on a day-to-day basis to make it a little bit more tangible and make it something where the average employee or average, director or VP at the company could really, get their head around what does it mean for us now? Like, how does it actually change my job on a day-to-day basis? Somehow, again, kind of connect their work more effectively to that outcome, to this efficiency goal.
Yes. For us, it's really been, since we're in the commerce business, it's been truly understanding and having all of our team understand the economics of a transaction and of the transaction. And when you take a macro view and say, we're an unprofitable company, very simply stated, that means you have more expenses than you do in revenue. And in some instances, when you're running a transaction business, it might mean that it costs you more to get a transaction than the money that you might make to support or to create that transaction. And so for us, profitability really has been important for us to say we need to be able to create a company that has endurance, has sustainability, but that we can support delivering the customer experience by having a model that says that we can achieve revenue, but we can get greater scale by not having to spend more than what it takes to get that revenue. And that has probably been the thing that for us as a company, and having everybody understand the economics of the business, understand the costs that go into acquiring a new customer, but retaining a customer, and then operating the business and connecting that to, the revenue, has been really important for us, all of us in all of our different functions, to appreciate, well, what is my contribution to that one transaction, and how can I drive and be more efficient with that, because that will unlock new areas of investment that we can go into. And so that's probably been the biggest change for us, is a real focus on our unit economics and a real focus on all of the costs that go into that, as a way to unlock people and teams to think bigger, but to think of their contribution to that specific transaction.
Got it. No, that's helpful. And one of the things I talked about this morning was how averages can be very misleading. And you could look at kind of the average transaction and the average revenue per transaction, the average cost per transaction, but that tells you very little about what's actually going on, throughout the business. And in fact, there can be a significant variability depending on where does the transaction come from, what type of customers. And Sam actually also talked about this in his presentation, the notion of a whale, or somebody who spends a lot versus an infrequent buyer. And you would, spend more money to buy the whales if you could identify them up front than you would potentially the less frequent buyer. And so were there any best practices in how you guys did your presentation and how you did kind of this contribution margin analysis, so that you could kind of get away from the average and really understand, either which channel or what type of customer was most valuable, so you could double and triple down on those and move away from others? I think maybe it was a marketing channel or a specific customer type. Like, any best practices for how to do this segmentation that the founders and the audience can learn from?
Yeah, so we have broken up our business to, first of all, start at revenue, make sure you understand revenue, and then the simple costs of revenue, what it takes to get to a gross profit number. And then we have two concepts, one called contribution margin 1 and contribution margin 2. For us, contribution margin 1 looks at the customer support costs and the operational costs for us to deliver a transaction. And then contribution margin 2 is when we layer on the cost of acquisition and marketing. And so if I just spoke specifically about marketing as an example to your question, Roger, for us, the great unlock was actually moving away from the average. And for us, that average, if you looked at cost of acquisition or CAC to LTV as an average, you'd be sorely misled. And for us, differentiating a existing customer from a new customer, and what you're acquiring and how much you're spending to both retain a customer or to get a new customer is an important fundamental difference. You can't average the two. They're very different. They should be different. You should be spending much less to re-engage an existing customer than to get a new one. And then also understanding the channels by which you're acquiring those customers. So for us in marketing, and particularly in performance marketing, understanding a customer that comes in organically or through SEO or through Facebook or Google or Snap or through affiliates, until you understand your acquisition cost by channel, by customer, you can't actually get to an understanding of your actual cost to your lifetime value. And you can't get to an understanding of what that contribution margin might look like for those different types of customers. And so for us, the big transition was getting really clear about attribution, and then really being clear about those cost of acquisition in all of the different channels. And then it unlocked a whole new way of thinking as to how we should be spending, where we should be spending, and then how we can test to get better and more efficient about what we do.
Got it. Okay. No, that makes sense. Some of my other companies have gone through similar exercises, and it's really amazing, like what insights get unlocked once you start going through the segmentation and contribution margin analysis, and things that you took for granted or assumptions you had are oftentimes, really, become questions, and you get a lot of clarity in terms of what part of your business is really working, what parts aren't. So hey, just quick reminder for the audience, we've got a few minutes here. I've got another couple questions, and then would love to get some questions from the audience that we can ask Scott directly. So Scott, maybe back to getting the team to buy into the kind of this, migration to efficiency. Anything to avoid? Were there any kind of pitfalls or any mistakes that you feel like you made, or that you've seen other, founders and CEOs make as they try to transition the culture of the business that you would be willing to share?
Yeah, I'd say I heard Sam say this, but one of the mistakes is holding on to the sacred cows, or holding on to some of the limiting beliefs about what you are as a company. And we, you see that in terms of holding on to expenses, holding on to a way of going about your business, holding on to, particularly teams that had developed over time. And the more that you have those things that are untouchable, the more it becomes very, very difficult to make the changes as you go through those transitions. And so the other pitfall that I've both experienced and seen is to make sure that you're connecting what you're doing to the vision and the purpose of the company. It doesn't translate for most teams to just talk about profitability or just to talk about the financial outcomes. Most teams don't connect to that. They connect to, what am I doing on a day-to-day basis, and how does what I'm doing connect with the vision and the purpose of the company? And so one of the pitfalls is really not connecting those things to a vision. And for us at StockX, we've been around for 4 years, and now we're going back and revisiting what are some of our cultural foundations? What is our vision? How has that evolved? And what are the things that we can just ignore that were part of our past that we can set aside and say that may not be part of our future? And as we've been able to go about that, it's unlocked our ability to rationalize decisions, and it's hopefully unlocked a new way for our team to get motivated around the things that we need to do to change the business to continue to grow and scale.
Got it. Okay. And then on the team side, just organizationally, are there best practices for running a more efficient team itself? Is it literally there's just fewer people in the organization, or do you rethink kind of the organizational structure, as you again transition from growth mode to efficiency mode? How did you kind of rethink the org and the team around you to make sure you could execute on this vision?
Well, I think, every company that I've been a part of has gone through organizations and reorganizations, and that change has been that constant. And I think what's really clear is that you need to have an organization that's set up very specifically for the goal that you're seeking to accomplish. And so I would say that there's not one organizational structure that works, but aligning your areas or your functions to your corporate objectives. I remember, one of the companies that I was part of didn't really have a connection to the customer. And so we reoriented and reorganized the business around the customer. I've seen other examples where you organized around the product experience, and then the product experience governed the structure that you would take. And so I think it's really understanding as a company or as a marketplace what you're trying to serve, and to make sure that you're organized to be able to attack that core functional goal, and then be really clear that that org structure may need to change, and most likely will change. And it might be every year or 2 years. And this feeling of reorganizations being constant is probably a good thing for organizations to go through, because you're always evolving to an ever-changing landscape.
Great. Well, Scott, I know we have a few questions here that have popped up. Let me go to the top of the queue. So first one is, Scott, how do you define efficient growth? What are your targets for CAC LTV? What's your target for first purchase CAC and revenue?
Okay. So in terms of efficiencies, there's a couple of different concepts that I think are really important. And I think it's mostly in the concepts of marketplaces. Efficiencies can be unlocked as you think about conversion is one efficiency. And that is thinking about the product experience and how you get people to convert at higher propensities, and thinking about the entire customer lifecycle and getting better at each step in that lifecycle to convert that customer better is a key notion of efficiency. And that's owned, typically by your product and your technology teams. On the marketing side, efficiency really is about acquisition and driving a lower cost of acquisition. And I think it depends on the company in terms of what that looks like. And it's a function of how many transactions you could expect out of that customer over a lifetime. What is the return that you're trying to get in terms of profitability of that acquisition over that lifetime value? And it really depends on the average revenue that you would get from that customer. And so I've seen the threshold from CAC to LTV and the returns associated with that first customer be drawn in from 2 years now all the way to 6 months or lower. I think many companies are now operating in a horizon where they expect or hope that the first transaction or from the first 6 months, you effectively have a profitable new customer acquisition. So those are some of the things that I would be focused on as you think about efficiency, both in product as well as in marketing.
Great. And Scott, the next one is, Scott, do you see StockX future as growing new exchanges organically, or partnering with others, or both, to capture new opportunity within this new normal constraint?
So StockX, we see opportunity for growth coming internationally. We've had a playbook of success to expand in international markets. We've established a playbook of success in other verticals beyond our core sneaker vertical. And I, for one, have been a part of marketplaces that have been multi-platform marketplaces, where over time, the consolidation of marketplaces becomes essentially multi-platform. And if you look at travel, if you look at hospitality, and most e-commerce platforms have evolved to be multi-platform. But I think for us, it's going to be largely over the next couple of years, the organic opportunity in front of us of, again, expanding our verticals and expanding our customer reach internationally, which will be our key drivers of success.
Great, Scott. And then see if we got time for at least one or two more here. So next one that popped up, what kind of attribution tactics did you apply? I assume this is for kind of by marketing channel to figure out, how you did attribution based on different customers.
Yeah, so it's customer, and for us, at a simple view, it's new or a retained customer. I think you can get into much further, deeper segmentation by personas of customers, however you might define that in your marketplace, and then by channel. Attribution by channel, critically important in all of the performance channels, as well as trying to understand for those companies that have brand and top of funnel awareness or consideration issues, to really start to try to attribute how awareness or consideration can drive efficiency in some of your more performance channels, where data is a more powerful informer of what that looks like. So I think it's across those vectors of by channel and by customer segmentation that I think about attribution.
Great. Well, unfortunately, we are out of time. There's a bunch of additional questions on here, because I think, Scott, you got a lot of people excited to learn more about the StockX journey and everything you've done there. But thank you again for your time. Really appreciate it. This is a great session. We're going to, I think, hit the pause button now, and then we have another set of sessions coming up in a few minutes here. But Scott, thanks again.
Thanks so much.